Something unusual is happening in corporate America. Some of the richest companies in the world are sitting on mountains of cash, and they're still raising even more. At first glance, it doesn't make any sense. Why would a company already worth hundreds of billions, or even trillions of dollars, continue borrowing money, issuing debt, or building enormous cash reserves? Shouldn't they already have more than enough? For years, many people believed companies only raised cash when they were in trouble, when sales were falling, when profits were shrinking, or when they simply needed money to survive. But today's corporate giants are doing the exact opposite. Many of America's strongest companies are raising capital while they're making record profits. So what's really going on? Why are some of the most valuable businesses in America acting like they're preparing for something much bigger? The answer reveals one of the biggest changes taking place in modern business. Because today, cash isn't just about survival, it's about speed. For decades, businesses raised money to build factories, open stores, or expand into new cities. Growth happened gradually. Companies had years to prepare for major investments. Today's economy moves much faster. A breakthrough technology can completely reshape an industry almost overnight. Artificial intelligence, cloud computing, advanced semiconductors, cybersecurity, automation. Each of these markets requires enormous investments, and companies don't always have the luxury of waiting. When opportunities appear, they need to move immediately. That requires cash. Lots of it. Imagine a company suddenly finding the perfect acquisition, or discovering a revolutionary technology, or securing land for a massive AI data center. If competitors are chasing the exact same opportunity, waiting even a few months could mean losing it forever. Cash allows companies to move first, and in business, moving first often creates an advantage that's difficult to catch. That's one reason America's largest companies continue strengthening their balance sheets. They're preparing for opportunities that may not even exist today. Technology is a perfect example. Building next-generation AI infrastructure costs billions of dollars. Constructing advanced data centers, purchasing specialized processors, expanding cloud networks, upgrading cybersecurity, developing custom chips. These aren't million-dollar projects, they're billion-dollar commitments. Companies with strong cash positions can invest aggressively without slowing down their everyday operations. But investment isn't the only reason. Economic uncertainty also plays a role. Even profitable businesses know markets can change quickly. Interest rates can rise, supply chains can be disrupted, consumer spending can slow. Global events can reshape industries with very little warning. Holding significant cash gives companies flexibility. Instead of reacting to uncertainty, they can continue investing while competitors are forced to cut back. History has shown this repeatedly. Some of the biggest corporate winners emerged from difficult economic periods because they had the financial strength to keep growing while others focused on survival. There's another interesting reason companies keep raising money. Debt isn't always a sign of weakness. In fact, many financially healthy companies intentionally borrow money even when they could pay cash. Why? Because borrowing can preserve financial flexibility. Instead of using billions from existing cash reserves, companies may finance large projects while keeping cash available for future investments or unexpected opportunities. It's less about needing money and more about keeping options open. Another factor is acquisitions. Some of the biggest business deals happen with very little warning. A promising startup becomes available, a competitor decides to sell, a valuable technology company enters the market. Businesses with readily available capital can respond immediately. Those that can't often miss the opportunity altogether. That's why cash has become one of the most powerful strategic assets in corporate America. Wall Street understands this. Investors often view strong cash reserves as a sign of stability rather than hesitation. A company with financial flexibility can weather downturns, fund innovation, reward shareholders, and pursue growth, all at the same time. It's one reason financially disciplined companies often command higher confidence during uncertain markets. Interestingly, this trend extends far beyond technology. Healthcare companies are investing in research, manufacturers are modernizing factories, Retailers are improving logistics. Financial institutions are expanding digital services. Energy companies are preparing for new infrastructure projects. Across industries, businesses are positioning themselves for opportunities that may arrive much sooner than expected. Consumers rarely notice these decisions. Most people only see the finished products: the new smartphone, the faster delivery service, the smarter software, the improved healthcare platform. What they don't see are the years of planning and billions of dollars that made those innovations possible. Cash quietly fuels those investments long before customers experience the results. Of course, holding too much cash also creates pressure. Investors eventually want to see that money put to work. They expect companies to invest wisely, acquire valuable businesses, develop new technologies, or return capital through dividends and share buybacks. Simply storing cash forever isn't the goal. Using it at exactly the right moment is. That's the real strategy. Corporate America isn't stockpiling money because executives are afraid. They're preparing to act, preparing to invest, preparing to acquire, preparing to innovate. In today's economy, opportunities appear faster than ever before, and the companies that move first often shape entire industries. Perhaps that's why America's biggest corporations continue strengthening their financial positions even when business is already good. They're not raising cash because they're expecting failure. They're raising cash because they're preparing for possibility. Because in a world where technology evolves at record speed and competition grows more intense every year, having access to capital may be one of the greatest competitive advantages a business can have. The next breakthrough, the next acquisition, the next billion-dollar opportunity. It may arrive without warning, and when it does, the companies with the deepest resources won't need to ask whether they can afford to move. They'll already be ready. That's the strange reason America's biggest companies keep raising cash. They're not preparing for today's economy, they're preparing for tomorrow's opportunities.